on the webcast today. Welcome to our virtual roundtable discussion on the topic of mitigating regulatory criticism of your bank's KYC EDD program, co-hosted by Withum and AML Partners. Our agenda today is to get through the various introductions and engage the panelists on a number of KYC EDD questions and discussion points, concluding with an audience-driven question and answer session. Like many of you, we have faced many difficulties dealing with the unprecedented challenges posed by this pandemic in our home and work lives. And as a way to give back and also to add value to our industry, my esteemed colleague, John Almeida, and myself came up with the idea of bringing useful content and hard-earned insight from our esteemed panelists to your home offices. As of this morning, we have over 100 confirmed registered attendees across the financial services industry, most of whom are senior compliance leaders responsible for their firm's KYC EDD compliance. Many of you already know us, and for those that have joined us for this event, Withum and AML Partners bid you welcome. We do hope that you will find this session to be useful and informative. Please be sure to engage the panelists during the question and answer session at the latter part of our event at the chat through using the chat function. For those interested in our CPE credits, please be sure to participate in our polling questions throughout the presentation.
Thanks, Peter.
Great. So introduction. So my name is Peter Kim. I am a principal with Withum's Forensic and Valuation Services Group, specializing in regulatory compliance consulting services. I have experience extensively in the financial services sector with a diverse background as a former Federal Reserve Bank New York regulator, financial services consultant, and compliance leader with various U.S.-based financial institutions and foreign bank organizations.
My name is Jonathan Almeida. I'm one of the founders of AML Partners. We're a software development company. Used to be in New York City, now moved to Concord, New Hampshire. My history with anti-money laundering and compliance goes far back as 1999 when I joined a firm called Prime Associates. I worked for Prime for about 6 years prior to starting AML Partners. Thank you all for joining. Appreciate it.
Good afternoon, everyone. Thank you, Withum and AML Partners, for inviting me to join in this webinar session today. My name is Kevin Choi. I am the Deputy BSA Officer for Sumitomo Mitsui Banking Corp, also known as SMBC to many of you, as well as the AML Compliance Officer for our Cayman branch. As you know, SMBC is one of the largest banks in the world. I believe at the last count, it was number 13 in the world, and the second largest bank in Japan. So we have a presence here in New York, as well as kind of all over the Americas, as well as Europe and Asia. So it's a fairly large bank. We do not deal with any retail customers. It's a corporate bank with a very large correspondent banking activity. So that's where I am. Formerly, I was the CCO and BSA officer for Israel Discount Bank of New York. I know some of my former colleagues are on this call, so welcome. And prior to that, I was also a consultant, and I've also worked for a regional retail bank here in New York, working in the area of BSA, and I was also a former regular at the Fed, just like Peter.
Yeah, hello, good afternoon, everyone. My name is Micah Halleck. I am the BSA officer and compliance officer for Nungyup Bank, which is a foreign branch. Very similar to everything Kevin described, except we are very orders of magnitude smaller. And our activities really are, we are here, as many foreign branches are, to serve as the correspondent with our parent bank, Nungyup Korea. I've also was the BSA and compliance officer at Shinhan Bank America. Prior to that, I worked for HSBC in their compliance testing unit. And without, since we're on have very short amount of time, I'll just sort of fast forward. I've also spent quite a few years in the consulting side, doing the kinds of things that Peter and Jonathan are doing. I was also, as you can see, I think what's pertinent to people, many, many years ago, I was an examiner with the Office of the Controller of the Currency. I will say it was so long ago, BSA, if you can imagine, was not even a broken out specialty. It was something that was done by the generalists. Having said that, I've been in BSA for about the last 25 years of my very long career. And with that, I'll hand it off to the next panelist, Abel.
Yes, thank you so much for inviting me. My name is Abel Picardi. I've been in compliance for, I would say, over 25, 30 years. My recent engagement has been as a former Chief Compliance Officer and Managing Director of Bank of China. Previous to that, I've done some consulting and worked also with media such as Compliance Advantage, and I also was with Australia New Zealand Bank for 13 years as a Chief Compliance Officer. I worked also in other Japanese foreign banks, and also like Micah, and I was a former Federal Reserve Bank examiner. Thank you for having me as a panelist in this webinar.
Thank you. Once again, this is Jonathan Almeida. Appreciate all of the speakers. Some backgrounds you all have. Prior to getting started, I thought we should have this disclaimer. All contents and statements that are made in this event are strictly the opinions of us, the individual participants. Also, contents and statements made in the event are not recommendations or intended as guidance on regulatory requirements. We just thought that a lot of the items that we're going to be talking about is just essentially items that we are challenged with on a day-to-day basis, and we've picked specific topics specifically simply because they seem to be challenges with a lot of the institutions, and so let's essentially talk through some of the best practices on how to go about resolving them and solving them. So we just wanted to put that disclaimer out. Thank you.
Thanks, Jonathan. So we're going to get through about 5 questions in total. And the first question, this is a question mainly for Kevin, is regarding UBOs, ultimate beneficial owners. So Kevin, if you can, talk us through obtaining UBO information in terms of how the information is sourced, whether it's at the time of onboarding or on the refresh review, on what would be and also what would be the schedule.
Yeah, thanks, Peter. So I think everyone is pretty clear by now on what the requirements are. It's been 2 years, when this went into effect on May 11, 2018. So there are basically 2 ways to satisfy the identification portion of the UBO. Obviously use the certification or use formation documentations from the customer, right? I think the CDD rule has allowed for use of the certification, so a lot of the banks are using that, which is the easier way to go. So you can use it, you can rely on it unless you have reasons to believe that the information provided is maybe inaccurate. But if you do think that it's inaccurate, my recommendation is that you move on to collecting formation documentations. Now, that gets a little more complicated, obviously, right? Because for each type of different legal entity, you have different types of documentations that you can collect. And of course, if there are layers and multiple layers of entities, what do? Do you go down the train and just collect that documentation from all of the layered entities? Now, that gets really difficult and complicated when those entities themselves are refusing to provide that information to you. So, just wanted to highlight that, and for different types of, let's say it's a corporation, you would have to get the share certificates or registries, LLCs, operating agreements, partnership agreements that will kind of lay out who the members or partners and then their ownership percentages are. I just want to highlight a couple of things. we've all been through these webinars on CDD and beneficial owners, and in general, I mean, I think people walk away kind of saying it's like, oh, I know this. I don't think I've learned much. So my goal is to kind of at least have you guys walk away with a couple of interesting facts that you can learn from here. So I do want to kind of get into the little nitty-gritty details that you may not have thought about. Okay, so with corporations, obviously that includes bearer shares. And I know a lot of banks do not deal with bearer share customers, but when you're dealing with legal entity customers, you may have some customers that are shareholders in the form of bearer shares. So what do you do in that situation? My recommendation is because obviously they're very high risk. You would have to collect the copies of the original bearer shares, or maybe a certificate that certification from the customer that they're still in possession with the customer, with the beneficial owner. In many countries like Uruguay and Panama, I think the central banks require the owners to register with the central bank, so you can request that documentation from the customer, from the beneficial owner, that they have registered. And then you also need to do some due diligence on which countries actually have prohibited bearer shares, like the Cayman Islands. They've recently prohibited them, and they said all the bearer shares must be registered or transferred into registered shares. So you have to do a little bit of due diligence when it comes to very high risk areas like that. Something with LLCs, obviously an operating agreement will give you memberships, but some operating agreements get very, very complicated. They'll have different appendices in the back that goes into different types of members, type A, type B, type C, and it goes into kind of caveats on when those ABCs kind of come into play. So, try to digest that, read that through, and then if you can't understand it, I would reach out to your legal counsel for some guidance on some of those things. Let's see. So, obviously, FinCEN does not, say one is preferred over the other method, but you do have to take an AML risk-based approach. If you think that the AML risks are too high by just collecting the beneficial ownership form, you may have to take that extra step. Now, on the verification side, you're obviously allowed to use either documentary or non-documentary, which is consistent with your existing CIP policies and procedures. So just make I would ask that you ensure your CIP policies and procedures for your regular individual customers allows you to meet the same requirements for your beneficial owners, right? So it doesn't kind of handcuff you. The only exception, obviously, what's that?
Go ahead.
Yeah, the only exception here is that you can collect photocopies of the beneficial owners, whereas you're not allowed to do that when you're CIPing your customers. One other thing I would mention is because I am the AML officer for the Cayman Islands, you'll have different beneficial ownership and CIP requirements for different jurisdictions, right? So, for instance, I don't know if anyone has to deal with SEBA, which is the regulatory authority for the Cayman Islands. They've recently come out with different beneficial ownership rules and certification and verification rules where not only do you have to collect IDs for the customers, but you have those IDs themselves have to be certified by a third party, and they give you very specific guidance on what that certification requirements are. So those are the different challenges that you have if you have to deal with other jurisdictions and their regulators. And we also have a Japanese CIP requirement, which is a little bit different from the US requirement. So
Kevin, do you mind if I ask you a question on that?
Sure, of course.
Sure. Are you using public sources to be able to validate that kind of identity information, or are there companies out there that you're sourcing the information from? Talk about that.
We do both. We do receive IDs, and in situations where we cannot, or we have a hard time getting that information, we do look for some public sources. A lot of them are, from reputable sources like public, financial statements or regulatory filings. If they're publicly traded companies, so it varies. And on the second topic on refresh review and what that schedule may be, I think the refresh of beneficial ownership, it's driven by your trigger events as defined by the CDD rule. The one thing to note is that if you look at the CDD frequently asked questions number 14, it states that we have no obligation to update the UBO information at periodic reviews, basically. I know a lot of banks do this. You are not required to do this, okay? Absent specific risk-based concerns, that is not a requirement. And then one other thing I must note with periodic reviews is, a lot of banks, they update CIP on a periodic basis. And that is actually not a regulatory requirement. If you understand what a CIP is, it's identifying a customer at the time of onboarding, right? And like, for example, take Kevin Choi. My identity does not change after I have been onboarded, so there's really no reason to update that periodically. I know banks do it, and I know some examiners have even asked banks to do this, but you do need to push back and say where in the regulation are we required to update the CIP for the customers? Let's say driver's license for the customers or beneficial owners. That is really not a requirement. Okay, so trigger events. Obviously you define what the trigger events are. One required trigger event is the opening of a new account by an existing customer, which excludes renewals of CDs, loans, and you're aware of that. But the key ones that you should probably know are when you file a SAR on a customer, when you name this customer as a subject, if there's any material negative news on the customer, knowledge that their ownership may have changed, if their legal entity name, corporate structure has changed, things like that. There's a whole slew of trigger events that you can look up online, and I'll be happy to share that with you afterwards. You don't have to do everything, obviously, but it has to fit your bank. It has to fit your bank, your risk appetite, and who your customers are. Okay, but just make sure that whatever you put down in your policies and procedures, you're able to handle, because you will be tested against your own policies and procedures by both the regulators as well as your internal auditors. Okay. The next bullet, how reliable are the sources? Obviously, like I mentioned, you can rely on the information that your customer provides if you're using the form. The percentage of ownership collected, that's risk-based. I mean, FinCEN is very clear on that. The minimum is 25%, but you just have to. A lot of this is kind of dependent on your risk assessment, AML loan of fact risk assessment, right? Where are you operating? How risky is your bank? Where are your customers located? Are they in the HIFCA-HIDA regions, right? Are they large corporates, small businesses? Which jurisdiction are the customers located? What types of businesses are they? So, my prior bank, I'm not going to say who, my prior bank, our domestic customers are generally, small to mid-sized businesses in the New York City, New Jersey, LA, Miami area, in the garment, jewelry, real estate, charitable organization area. I mean, that's as high risk as you can think of, right? So in these situations, I mean, I would advise that you go down to a level lower than 25%. And you just have to be able to justify that to your regulators later on why you're doing that. And my recommendation is, if your system and process can support it, you have set kind of different threshold, different percentages for different types of customers. You don't want to just apply one minimum requirement across the board. That just makes it very difficult. But at the same time, don't get overzealous and have different settings for every single customer, because you won't be able to manage that. Okay.
Wonderful.
The last bullet is on the exemptions. I know I'm taking up too much time, so I'm going to try to speak really fast. I'm from New York, so I speak really fast. So there, obviously, you guys are aware of the 14 exemptions that it's allowed under the CDD rule. So the 14 groups of entities that are excluded from the definition of a legal entity customer, and then additionally there's two other exemptions that are allowed just under the ownership prong. So I do want to focus on a couple of exemptions that are often, I think, unclear or misunderstood. or misinterpreted by many people. So one is the subsidiary of a listed company exclusion, right? So this is when you have a subsidiary, a customer that is a subsidiary of any U.S. listed, U.S. public company, and you can exempt that from the CDD rule. So, but the regulation is very clear in stating that the subsidiary must be organized in the U.S. I know a lot of banks have taken this and kind of interpreted it as we can apply every subsidiary, whether they're incorporated in the U.S. or not. And their reasoning is that the filing requirements with the SEC is the same regardless of whatever. So the SEC has all that information. But I would highly advise against that. I mean, the rule is very clear, and if the examiners were to come and say, why did you exempt this company that's organized in China, you really wouldn't have a very good response to that. Another exclusion is the foreign financial institution exclusion. So this is when we have a foreign FI that's established in an area where they have where the regulators maintain the beneficial ownership information on the FI. So you can exclude that. And if you look at the CDD fact number 26, it says that we can rely on basically what the customer is telling you. If you provided that you have no knowledge of fact that would reasonably call into question the reliability of such representation. So I know the fact says you can just rely on what they say, but I would advise you to do a little bit of due diligence to make sure that that information is accurate. So I would check the regulator's website, or find out what the registration requirements are for the financial institution in their local jurisdiction. You can even contact their local regulator. They've gotten back to you, and finally, you can even ask the customer to show you proof that the beneficial ownership information is in fact maintained by the local regulator. So, the last thing I would say is just you read and reread that CDD frequently asked question documentation. It's quite long, but it's actually kind of fun. And I know we're all stuck at home nowadays, so you have all the time in the world to read what you always want to read, which is AML regulations. Yeah, so that's all I have on this slide.
Thank you for the great information and great insight. If you enjoy reading that stuff, Kevin, you're sicker than I am.
Yeah, that's right.
So I wanted to open it up to the other panelists to give Micah and Abel an opportunity to add or provide a counterpoint. I know Kevin just gave a great response to the UBO question. Micah, do you have anything to say?
Yeah, I definitely don't have any counterpoints. I thought that was very good. I think one of the things I would just sort of highlight, or something I think I can add, and I'd be curious. Yeah, I think other jurisdictions, and I'm only really familiar with Korea and the U.S., but I think other jurisdictions have used different thresholds for UBO, and I believe Germany in the European Union, because they tend to look at things in a very straightforward common sense. I'm not sure they have any threshold. I believe they say there's beneficial owners, you got to look at them, which means more work, but it also just makes it very clear cut. You don't have to worry about what are we going to do? Are we going to have it by risk level? Are we going to have tiered approach and things like that? But the takeaway, as Kevin touched upon, it does vary from jurisdiction to jurisdiction, and you have to be mindful of that.
Great, thank you. Abel, do you have any comments?
Yeah, I think Kevin has done an excellent job in outlining all the requirements and basically from a best practice. And now getting back to the current situation, right? How's the UBA process, UBO collecting documentation process will change given that we're going through I would say, a new structure or for all types of business given the pandemic issue? How would that change on the collection and verification of that information, of any changes within the customer's structure?
Wow, that's a great question, and I do remember seeing a regulatory guidance that touched upon relaxation of certain standards, especially with the current PPE loans and such. But in terms of general regulatory guidance on that matter, I think it's still being formulated and disseminated. I don't know if you guys have heard different, but I haven't heard anything concrete coming from the regulators.
Yeah, and that's where, this is the time for us, all of us, especially attendees, that most of them are CCOs. And this is where we need to set the standard ourselves before the regulators come in and tell us, okay, this is how it's going to change from now on. So the question is, all right, how do we look at our institution and the information and the data that we have in-house, how's that going to change? How do we verify going back to the customer? Because this is a good way. Now we're talking about refresh. This is a good, a good practice to go back and do the refresh with this customer, especially the ones that have been rated high risk. You want to have a conversation with people within, executives within the customers, and come up with a way, right? That information, because you're having that contact, conversation, you will learn other things that's going on currently within the company. And maybe if you look also within your institution, look at for example, loan department, right? Are they collecting information that they haven't shared? And you need to document it, because if the regulators see that you've done the process, I think that will show them that you're being proactive. And that's the key here. We can't sit back now because of what we're going through. We got to be proactive and preventive.
Great. Thank you, Abel. At this point, just to move things along, we're going to turn over to Matt from Withum, who's going to deliver the first polling question. Matt?
Yes, so we're going to start our first poll of the presentation. Just as a reminder, please be sure to answer for CPE credit. And also, I've been told that there are some issues with seeing the submit button if you're in full screen mode. So if you're not seeing it, if you just get out of full screen mode, you should be able to see it. But worst comes to worst, you can always comment in the chat box as well. So our first polling question, is there a central electronic repository for UBOs, board members, signatories, and guarantors? Yes or no? Right, about 50% participation right now, but we do want to close up the poll in the next few seconds, so if you could be sure to participate if you plan to. Okay. As you can see, about, I'm going to share this here, I'm sorry. 60% of the people said no. Sure if we have any comment on that. And then if we'd like, we can go to our next poll as well, which is, does your institution track relationships / linkages of SBOs, signatories, etc. with multiple customers? Yes, our KYC program backs relationship or tracks relationships, linkages. No, the relationships are tracked manually. No, we do not track relationships. We're so far seeing about a pretty even split of responses at the moment. We're gonna close this up in just a few moments if you want to get your last few responses in there. Okay. And as you can see, most people said no, the relationships are tracked manually. Okay.
And for all the audience, I mean, there's a whole, you know, when we're as consultants, as software developers, when we're out in the field talking with different clients, we're constantly asked, you know, how do we compare, we the client, how do we compare to some of the other clients out in the field, you know, and we give our answer to the best the best way we know how. And when it came upon time to sort of put this this webinar together, how better a time to sort of poll the audience and for everybody to see how they sort of rank and rate compared to the audience. So this way this is a way for also for you to see kind of, you know, if there are issues that you're challenged with, you can see that it's not just you alone. That some of the other institutions are having just as much of a challenge in doing this kind of tracking. And, you know, based on the answers, I think you know what the issues are, right? So if you're doing it very manually, then here comes the duplication of collection of information, or the triplication of collection of information, and without necessarily having that linkage. And I think that dovetails nicely into the this next slide regarding negative news. Michael, this one's for you.
Yeah.
Same question, right? Give us your thoughts on essentially what institutions generally do, not necessarily yours, but just thoughts of what institutions should do, perhaps.
Sure. I'd say the way I interpret and take home what Jonathan is saying is, you know, misery enjoys company. So we are all, I think, even those of you who have automated KYC systems, I'm sure you struggle with that because then you're swimming in data. So the first question, what information is generally screened besides customer? I guess, you know, what entities are actually going to be. Generally, I mean, I have to say, I know, and this might be the regulator in me seeping out, but for negative news screening, whether you have automated systems or some sort of hybrid of manual review of automated negative news, I would say, you know, you're going to be fairly conservative. By that I mean, yeah, if you have beneficial owners, regardless of the the percentage of ownership, you're going to want to at least include them at onboarding in your negative news searches. And of course, you know, signatories, guarantors, board members, certainly inside board members, members who might be part of the ownership structure. Certainly they probably qualify for the control prong. But again, you're also dealing with that other even more soft and squishy reputation risk. So if a board member of your company gets involved in something, but they happen to be a limited owner, or maybe even just a outside board member, it's going to have an impact. And also, and I think Abel was getting to this, in terms of negative news, certainly compliance BSA has to do their share. But this is something, if it's a loan customer, your credit analysts are going to be aware of this as well. So this is something where you can provide a value added. I mean, those of us as compliance officers, we're tolerated. We aren't necessarily, I mean, I say we're accepted and tolerated. I don't know if we're endorsed. But I would say for that first question, yeah, it's kind of cast the wide net. And then, yeah, the second question, more or less covered, like I said, the types of names. Well, like I said, anyone who's a beneficial owner, a controller, officer of the bank, certainly if they're a signer on the account, guarantors of the loan, you bet. Again, board members with the larger companies. And again, and I think kind of circling back and to Kevin's presentation, negative news it can be a trigger event, right? So that, I'm kind of getting into the third question, but you want to have some sort of schedule for negative news runs because, you know, what's the old saying? News never sleeps. Well, it is, you know, it is a very dynamic thing. So again, I think, you know, my answer is that in terms of types of names, yeah, you want to get anyone who has certainly an influence on the account, on the relationship, and on the company. And as the first presentation and some of the polling questions, I think, alluded to, you know, when you get into beneficial ownership, you start seeing the spider webs, and by that I mean, you know, the connections between certain affiliates and companies and things like that. So, and you know, one bad news in terms of, you know, one entity or one individual can color quite a bit. You know, it's the old whatever, pebble thrown into a pond. So I think, you know, and for us, you know, to kind of steal the line from Abel, we, as much as you can, you want to be out in front of that. So that means you're going to cast a broad net. And I think, you know, at least I can say this about negative news, even for the smaller branches or banks, you know, community banks that are in our audience. This is kind of, you know, the ounce of prevention, right? I mean, this is something you can do. Even reviewing, I mean, you can get stacks of information on negative news. You have to figure out what you're actually going to take, how many hits you're going to get. But it's something you can do. It's relatively, compared to other things in AML, it's low cost, and it can be preventative. There, you know, there's a number of other aspects. I think if we'll see, you know, if there are any questions, I'll delve into that. Getting to the third question, a good practice pertaining to the frequency of the screening. It touched upon this a little bit. Generally, what I see, and again, this is, you know, I see what I see. But at the other institutions I worked for, generally, anytime you are doing a review, you know, you do it at onboarding, and then when it's slated for a review. So if it's a low risk customer and, you know, it's on your low risk cycle, that's when you're going to do a negative news search. Same thing with moderate and high risk. You know, I have seen, and since this is sponsored by consultants, I don't, but, you know, I mean, there are some people out there who are like, oh, you know, just remember the news never stops. You know, I'm not a, you know, I don't think you have to like have overnight news services. I mean, I would say if your customer is so high risk that you feel like you've got to do it more than, you know, quarterly or monthly, you know, there might be other things going on with that customer, but I would keep it on your review schedule.
Hey, Micah, I'd like to actually ask you a question. Obviously, we've all done adverse media negative news searches before, and it's a pain, right? You got to put in names, the run searches. Can you share any information about what are some of your best practice for operationalizing these searches? Do you put it on a list? Does it get fed into a system automatically? As you mentioned, do you have an automatic service bureau that spits out negative news? Just wondering, for the benefit of the audience, how you have conducted these things so that you can have a bit of an operational efficiency.
Yeah, and I would say I have, in my experience, we do not have a KYC onboarding application, and we don't have a fully automated negative news search. And I think even the examiners have gotten to the point, though, they are pushing for, you have to have defined strings. You know, you can't just get away with putting a name in and seeing what comes up. You need defined strings. I would say those need to be in your procedures. And in terms of, you know, the other thing is the output. You do need to have, I'm not saying, you know, it's not a policy, but certainly a manual or something that, and you have to rationalize what you're going to take, because yeah, as you know, you tend to get quite a bit of information. One thing I'll seek, and I see we do have a question, I want to get to that, is one of the things we do, I mean, we do use a service, you know, that's, and I don't, not sure what the rules are. I won't mention it, but I mean, it's a commonly known service. We also use Google search. I will say, you know, our institution, we are dealing with regulatory action, so we have to go a little bit, you know, whatever, higher, faster, longer. But part of that is just to try to get a second voice, because as we know, one thing about negative news search is then you kind of have to figure out, okay, is this real? Is this something that's verifiable? And at least if it's showing up in other sources, that's one way to at least give you some assurance. The question we got is, do you include all names being screened, including guarantors, in one single system for ongoing screening? If I understand the question, so I guess if you cast the wide net at onboarding, do you continue that with the whatever the update schedule is you're on? You know, the short answer is yes. If you can rationalize, you know, perhaps if you have a very aggressive onboarding and you know, you spread a pretty wide net and maybe nothing comes up, then you can push that off maybe onto a more, you know, stretch out that schedule. But I think that's where that's what we're living in. At least that's been my experience. The feedback from examiners and auditors. I hope that answers the question.
Thank you.
And I think that's all I had. I mean, there were a couple of other things. I mean, that I've just seen, and I admit, you know, it's stuff that's more. This is not regulatory guidance. This is just things I've seen. You know, some institutions are categorizing the negative news they do get. I have heard, although I haven't seen it, that some are trying to weigh the negative news they get. Again, I'm hesitant to start risk rating the negative news. I think we're just creating work for ourselves. Frankly, it's either pertinent or it's not pertinent. You know, either it impacts your customer or customer relationship, or it doesn't. I think that's about as far as we can go. I mean, if other people disagree, I mean, definitely that's, you know, it benefits the other listeners and it benefits me to hear that. But again, it's, you know, we can bury ourselves in going out, you know, trying to risk rate everything we get.
Okay.
And I think we're going to go to our next poll now, if that's okay.
Go right ahead, Matt.
Does your institution screen all UBOs, signatories, guarantors, customers, etc., against negative news? Yes or no? And again, if you're having an issue, please feel free to answer in the chat box. Okay, we're going to look to close this in a couple moments if you want to try to get your last responses in. Okay. So it looks like the majority of people here said yes. And if we want to go to our next question. Assume negative news screening is performed at onboarding. What is next frequency of screening? Daily, weekly, monthly, quarterly, on periodic review? Okay, we're gonna close this up in a few moments if you can get your last few responses in there. So as we can see here, looks like the majority of people said on periodic review.
It's probably not a lot of weighing going on that on those daily screens, Micah, for those that.
I have to say that was actually 18% doing daily. God bless.
That's yeah. and this is
systems.
Right. And this is what I hear too with some clients. Right? They tell us that it's being done daily or doing it daily, and you've got to imagine the volumes that they deal with on a daily basis.
Yeah.
Right. And wait, this is
sorry. Just look at the disparity. Look how disparate things are, right? You've got daily compared to on periodic review. So now, if you're thinking low risk clients reviewed every 3 years, you've got on the far end, on the one end, daily versus on the far end with institutions doing it every 3 years. There's so much of such a range between the two.
Well, and for those of you who said periodic, and I am an advocate in that boat. I hate to say it, but the examiners are driving us to, it's kind of like water seeks its own level. If there are institutions out there, and size doesn't seem to really be a factor with examiners' reasoning, who are doing daily reviews, they're going to be coming at us with, are you doing daily reviews? And if not, why not? How are you rationalizing it and saying, oh, I'm a small branch, I can't do it. They just don't accept that anymore. Now I've got some homework to do.
Yeah. Well, Micah, the other issue is when you do so many reviews, right, at whatever section, you may run a chance of having a backlog, and that's even more dangerous. When the regulator comes in and sees that you have a backlog, that you haven't really finished the searches or analyzing the searches, and that can create another concern and problem for the institution, because then they're going to be looking at the resources, how many people you have looking at these things, should you hire more people, and the cost obviously it's exponential.
Right. So we're going to go to the next question. Abel, we're running a little short of time, so I would appreciate it if we could limit the responses maybe 3 or 4 minutes. So the next question is regarding the periodic review. If you can, please speak to, in terms of defining a periodic review schedule, what is generally a good practice? If you could start us off with that.
Right, and again, the periodic review stems from a risk assessment of all your product, services, and customer. You need to rate your customers, and again, whether you do it manually or automated, that comes into play as to how effective and efficient program you have, because that can create, again, as I was saying before, you don't want to run into a problem where, you're supposed to do high risk reviews of your high risk customers, and you're running a backlog because you're not performing on time, and again, it's based on your policies and procedures. You have to be able to document the fact that you are following your policies and procedures. And when you do these periodic review, right, it is how you examine, how you evaluate it, right? What is the quality of the resources that you have? What is the analysis? How do you keep up to date with changes in your customer? Do you monitor the breaches in the parameters that you have established for each customer? I mean, those are the things that you need to be careful. And more important is, if you receive one of these national security letters or or the fact that you're filing SARs on some of these transactions, customers' transactions, that pushes the particular customer in front of the line in performing a review, and that involves, as Micah and Kevin mentioned, collecting information about the ultimate beneficiary, conducting adverse notice, adverse information searches, and again, it is how you establish, that program, and that the only one that's it's yourselves, because your financial institution, the volume of accounts and customers that you have, and it has to be based, when you establish these processes, it's got to be that it can be implemented within your financial institution. Implementation is the key. And as far as that's concerned, is you need to be able to have controls in place to monitor whether these processes are working or not.
Great. So Abel, I'm sorry to follow up on the questions on the second and the third point for the periodic review. If you can you share with us in terms of tracking upcoming reviews for the periodic reviews, or what are some of the methods that you've utilized, and what successes have you had, and also when you are doing the tasks for periodic review, do you recontact the customers to confirm any changes that are happening?
Well, in tracking, obviously it is a lot easier if it's automated, because obviously not only it brings up the timing when it needs to, but if there is any new activity or breaches in the thresholds that you establish for the customer, it's easy to pick up. But if you do it manually, again, you have to look at the transactions that are coming in especially on the high risk customers. You need to focus on that to ensure that the transaction is not one that is unexpected or that the customer usually doesn't deal with, and that is sometimes it's hard to identify unless you monitor the ins and outs of that account for the customer. Again, from my perspective, when we looked at the tracking this account, we knew the high risk customers, and we knew each one what was going into the account. Especially, if you have a consent order, you need to do this process in an effective manner. But again, it is the resources that you have to analyze. As a CCO, you have to say, well, how many people do I need to do this the right way, right? And that the regulators are not going to criticize it. On the third point, what John performed, usually, even as a CCO, especially on the high risk customers, I call the CCO or the company or the CEO, and just have a conversation as to their business strategy. What do they expect in the coming month? What's going on as far as transactions? What is their business? How they're doing? Do they expect any changes of what they have communicated to us as far as transactions is concerned? It's as I said before, you need to contact the company, and because you may have some questions and you get the responses, but you may find out other information that you weren't expecting it, and that may change the analysis and evaluation of the customer. And again, the periodic review, it could be on a daily basis, depending on the risk that the customer impacts your financial institutions, and you need to make sure, obviously, even from an adverse note information that you get through Google or other sources, to make sure that if it impacts the reputation of the company, it will impact your reputation of your financial institution. So you need to be very careful in how you evaluate that and how you analyze that, because that's going to determine how often are you gonna review the customer, high risk customer, especially.
Thank you very much for your answer, Abel. So in the interest of time, let's move to the next question.
I think we've got only maybe a couple minutes for you, Kevin. If you could just maybe talk about even if this slide and the next slide, so we could just move on to. There's not a lot of time for Q&A. We didn't realize there was going to be so much of an interaction, but we appreciate it.
Yeah, so I'll go through this real quick. I mean, in terms of your relationship with your head office, for those of you that are FBOs or subs of foreign banks, I mean, you just need to set clear boundaries and expectations on who does what and who can see what, right? So everyone is very clear, and then you need to have very regular communication channels with them, so everyone is very clear. And in terms of a KYC system, ours is built in-house. Fortunately or unfortunately, there are positives and negatives to that approach, but whatever you have, it has to fit your bank, it has to fit your customers, fit what you do, what your business is, and it just needs to be flexible enough and configurable enough so that it's future-proof. So whatever regulation that comes down the pipeline, it has to be auditable, and then it also has to be able to easily generate reports that you need, right? So yeah, I'll just take the next one as well. I mean, best practices on working with enhancements. Sorry, Peter, John, but don't rely 100% on consultants. I mean, that's my advice to everyone. They come in, they promise you they'll do everything, but that they're not you. They're not the bank. You know more about your bank than the consultants do. So obviously, get their help, their assistance, but learn to push back because a lot of their recommendations, they've gotten from other banks. They may not be appropriate for your own bank. So I mean, the key here is obviously you have to have strong enough SMEs that know what they're doing and can push back and say, hey, argue with them and question what their decisions and come to the right agreement. Okay. Document.
I promise there was no. Kevin, I promise there was no sabotage there. As soon as you said, don't listen to this consultant.
And I can't argue with that. I was a BSA officer before, so it's like criticizing myself, but I completely agree with you, Kevin.
Yeah, so I mean, document, test. I mean, one example is a risk assessment, right? They'll come in with a 300-page risk assessment, and you just have to make sure it's sustainable, because that's what the regulators want to see. Even when you're under a consent order written agreement, and you have this beautiful risk assessment, it takes 4 or 5 people to do to work on this full time for a year. And can your small retail bank sustain this? It has to be right for your bank.
I know we're running through. That's the same way as it. Yeah, consultants give you the grand plan or whatever, the ideal. You have to actually sustain it. That's what you got to keep in mind. Sorry.
Yeah, and then one unique challenge for me, at least, with the KYC EDD program is I know some banks consider the CRR as a model, CRR under the KYC CDD program. It's a model under SRR 11.7, which kind of requires you to go through the whole model validation process. So it really depends on how complicated and complex how it's structured. But I know some people, I've seen the responses. Some people do it on a spreadsheet. I wouldn't say that's a model. That's probably an EUC, if anything. But like us, we have it kind of built into our KYC system. So that's been categorized as a whatever risk model it is, and it has to go through a regular cycle of model validation. So it kind of brings another level of complexity to what we have to deal with, in addition to the 504 validations that we go through. So we have 2 minutes.
Yeah.
So at the moment, we don't have any questions here, but if anybody does have any, I guess you could take a moment to write it in the question box now.
In the meantime, let me just take the opportunity to really thank the participation and the really free-flowing information sharing from the panelists. And I was just doing a quick calculation back on my hand. And I think between all of us here, we have over 150 years of compliance experience, and many instances where we went toe to toe with unfriendly management, board of directors, as well as the regulators. So I really appreciate the information and wisdom coming from the experience, really hard earned. So thank you very much for all the panelists. Do we have any questions, Matt? So.
We do not quite yet, but I will also take this moment to tell you that when you close out of the program, a survey is going to come up with the following questions, and we'd really appreciate if you take a moment to fill it out, just so we know how we did, and so that we can continue to give you some great content. One of the questions there is a recommendation on any future topics. If you enjoyed this, we'd love to do it again. So please take a moment to fill that out. And I am seeing a question come in. The question is, for ICP, what happens when someone gets married with a different name? Shouldn't the CIP be changed? I stumbled a bit there. Do you need that repeated?
Yeah, no, that's a good question. You know, I know I did mention earlier that your identity does not change, right? Which is for the most part true. You know, I don't think you have to. I don't think there's a regulatory requirement that says, you know, if your name changes, that you have to go through another CIP, because the regulation, like I said, is very clear that it's a one and done deal at the time of customer onboarding. You know, if your regulator says otherwise, I would kind of push back and go back to the regulation itself. Or, you know, we've actually had success reaching directly out to FinCEN. If you have questions, you can actually write them a question, and sometimes, not always, they have responded to you in writing, surprisingly. So, you know, if you have some specific questions like that, I would, you know, do not hesitate to reach out to them.
Yeah.
We have one other question. Yeah, so
go ahead, Peter.
Yeah, sure. We have another question. Our onboarding team is very particular about getting new passports if they are expired, and new W-9 forms if more than 3 years old. Is that really necessary? Micah, what do you think?
So yeah, I think I'll focus on the word necessary. No, I don't think, you know, there's no regulation, like you said, it's kind of, you know, you're on board and you're done. Where that comes into play, you know, where I hop on the other side of the fence, you know, obviously if it's an active customer or a customer that, you know, when they're adding a new account, you're back in the mix. So what I would say there is, if the onboarding team is trying to front run and say, look, you know, your customer base or this particular portfolio is very active, meaning they open accounts, they need new facilities and things like that. Okay, you know, maybe it's better just to keep everything updated as opposed to scrambling every time there's an account opening. If it's a very stable customer base, you know, they've had one account for, you know, 5 years or 10 years, you know, you're probably going to get pushback on that. But focusing on necessary, no. Nice to have, yes. Need to have, you know, you have to, again, it's rationalize it and sustainability.
Yeah,
Right.
If I can just add one thing, I think there's some confusion with a W-9 and a W-8. A W-9 does not expire, but a W-8 has to be renewed every 3 years.
Good point. Towards now we're at the bottom of the actually top of the hour, and we're a couple of minutes over. We did ask some pointed questions to the registered audience, and the results were tabulated for analysis, and we wanted to share with everyone the results of some of the questions that we posed. So the first question was audience questionnaire KYC program. Do KYC officers decide when EDD is needed? Majority of you had stated that yes, EDD is manually decided, which was interesting. The second question was during account opening, does your onboarding process use paper-based forms? Majority of you have said that it's a combination of paper and systems. And the next question was, is customer risk calculated manually via Excel spreadsheets or via automatic through KYC program? a good majority have said that it's a risk calculated via the risk models in a KYC system, and a minority said that it's Excel based. John, do I get this one?
I'll take it, sure.
Yeah,
another
sure.
audience question that we asked was, what's the average onboarding, what is the average time for the onboarding of corporates? This is another question that we're constantly asked. How long does it take to bring our corporates on? And there you have your answers. Not sure how many people, Matt, would you be able to tell how many? Oh, you can tell it right there towards the bottom.
Yeah, it was.
There you go. More than 6
yeah,
weeks.
close to 30,
There's a
yeah.
good, right. So there you are. So you kind of know which bucket you all fall into based on your answers. Let's move to the next one. Average onboarding. So the next two are the same. It's this one's for financial institutions. You've got some in the audience that where it takes more than 6 weeks to onboard an FI, versus there are some other that have it boiled down to a week. How are expiring documents tracked? So there you go. We're constantly asked. We use Excel spreadsheets to be able to track expirations of docs. So there you have it. A good portion of them manually being tracked. On to the next. Is there a centralized dashboard to present the state of KYC? So there you are. You know what your answers are, so you at least know where you stand within those particular answers. I mean, the answer that we provided were the best ones that we knew how. If there were other, if you felt you fell into other categories, please put them down as comments. Maybe we ought to think about better ways of maybe portioning some of these answers out. Certainly take any comments from you for that. Matt, was that?
Great.
I think that was, yeah, that was a lot.
Yeah, that was it. So we're 6 minutes over. Again, thank you very much to all the panelists for your active participation. I know that you guys are all busy fighting fires and dealing with issues at home, and really wonderful to see all of you in virtual mode. I think that was wonderful. And to be able to share all this with our colleagues out in the industry, I think this is impressive and very, very necessary service. So thank you very much on behalf of myself, Matthew, and the rest of Withum. Jonathan?
But Peter, before you leave, I want a quick just hand raise. Hi, hand raise up in the air. How many of you, this has been the first time since quarantine that you put a jacket on? Kevin's been working every day.
Hey,
Yes,
at least I wasn't going to go with the haircut there, Jonathan. I definitely need a haircut at this point.